Hello, welcome all of you to this short course on Indian mutual funds. I presume that you are from India and you want to invest in mutual funds, and it is for you if this is true. In this course, I'll take you through the whole gamut of what is a large cap shares, what is mid cap shares, what is small cap shares, and correspondingly, what is large cap mutual funds, mid cap mutual funds, and small cap mutual funds, how to identify them, what is the risk analysis required to be done concerning these funds, and the process of investment, and the entire thing related to that, what are the websites to be seen and which are the trustworthy resources, and so on and so forth. Of course, the usual disclaimer is that if you invest based on my advice, the loss is your own. I'm not responsible for it. I'm only here guiding you to the correct way. Okay. Thank you so much. Hello, welcome back. Today I'll take you through the various opportunities of investment available in India through the medium of mutual funds. Before going to mutual funds, let's have a look at the progress in the stock market in the last several years. I'll take you to the stock markets. I'll share a screen with you shortly. Let me share a screen with you. Fine. Now, there are several shares in the stock market. Out of these, let's analyze the top 600 odd shares, 600 or 660 shares in terms of market capitalization. In the sense, what is the total market value of all the shares issued by the company? What is the today's price? For example, Reliance Industries is coming at the top in India. 2,104 was the price as on 28th June 2021. Based on this price, the market capitalization of all shares of this company works out to close to 14,000 billion rupees. 14,000 billion rupees or 14 trillion rupees. Okay. The second company is 12,500 billion rupees. And if you organize the shares in the decreasing order of market capitalization, it looks like this. The top 100 shares will emerge like this. At the top is Reliance Industries, and out of 100, at the bottom is, I think, Jubilant Food. Jubilant Food has a market capitalization of 411 billion rupees. So 411 billion rupees to 14,000 billion rupees. This is the spectrum captured by the first top 100 shares. So if we call these as large cap shares, the large cap shares is what? Large cap shares is large capitalization shares. That is the top 100 shares in the market. So top 100 shares are Reliance Industries at the top, to Jubilant Food at the bottom of the pyramid. Now this can go on changing, depending on the market prices every day. This can go on changing. For example, which is 102 here may enter the first 100, or Bank of Baroda, if there is a pressure on selling, if the price goes down below 84, it may become less than 100, and so on. So what is important is top 50, 60, 70, 80 shares kind of remain same. Okay. So large cap shares we have defined. First top 100 shares are large cap shares. Next 150 shares, after leaving aside first 100 shares, that is number 101 to 250. 101 to 250, if you see, yes, Lux Industries is at 250, serial number 250. These are all mid cap shares. So large cap is top 100. Next 150 shares is mid cap. And what is the market capitalization of the 250th share? 108 billion rupees. So 108 billion rupees to 410 rupees, how much was it? 407 billion rupees is forming the mid cap space, as we call it. And rest of all the shares listed on the market below 250, whatever shares are listed in the market, are all small cap shares. Okay. For example, here if we go, the top share in the small cap space is Finolex Industries. Finolex Industries at a share price of 174 rupees as on 20th June is the 251st share, that is 108 billion rupees is the market capitalization. And Finolex Industries onwards, all other shares are small cap share. Now, what are the smallest of the shares? Like the shares which I have analyzed, first about I think 660 or something. Let me just go through the list. Yes, here is 663, serial number 663. The last share is Shankara Building Products, the price of which is 438, and the market capitalization is 10 billion rupees. Now, this is exactly not 10. This is a rounded off number. If you can see the formula here, okay, I'll be attaching this spreadsheet in the form of the course material, so you can at leisure go through the names of the shares. You can see the formulas applied and all that. Now, so what is therefore the market capitalization is large cap, top 100, mid cap, next 150, and all others after 250. Everything else is small cap. Okay, fine. Now, this is the market capitalization of shares. Let's take a look at the how the returns have been in the stock market. Like see here, I have tabulated two things: Sensex returns and gold returns. Gold is an alternative class of investment, asset class of investment. Therefore, let's compare gold and Sensex. Like here, see, if you see the first year, which is 1985, from which the data has been collected. In fact, data is existing for previous 5 years also. Okay. Now, today, the situation is in 2021, the prices are kind of comparable. See, the share index as on 28th June 2021 has been 52,773. This is the value of Sensex. Okay. And what is Sensex? Sensex is an index which measures the situation of the market based on top 30 shares. Okay, not top 30 shares, chosen 30 shares. So Sensex is a representative of the stock market. Similarly, Nifty is another representative of stock market comprising of some 50 shares. Sensex comprises of 30 shares, Nifty comprises of 50 shares. Okay, like if you see in the year 2021, that is now, 52,773 is the value of index as on 28th June. And gold has been in the same range, kind of, say 47,000. It was 50,000 earlier. Now it is 47,000. Okay, so they are kind of comparable. Okay. Now see, if you analyze performance from 1985 onwards till 2021, that's a period of 36 years. 1985 to 2021 is a period of 36 years. And what we have done is, we have taken the closing Sensex as in the month of December. Okay, that has been plotted. Okay, so 527 in 31st December 1985 has become in 2021, that is today actually. Okay, December is yet to come, 52,773. So 527 to 52,773 has been the growth in case of Sensex. Similarly, in case of gold, the growth has been 2,130, which was the price in 1985, to 47,000 in 2021. Okay, so this is how the data has been tabulated. Now let's analyze the returns over a 5-year period. Returns over a 5-year period, in the sense, it is not returns for 5 years, it is return for 1 year calculated on a rolling basis for 5 years. In other words, for example, this 527 was the index in 1985, and I have said that this gives an annualized return of 28.9%. So 5 years before 1985, if we go, that is 1980 to 85, these 5 years have given an annual return of 28.9%. Okay. So that way, if you see 5-year period at a time, rolling returns annualized, out of 1 to 37, that is 37 occasions, the rolling returns have been negative only on 3 occasions. Where are the 3 occasions? In 2012, the returns were 0.9% with a negative sign. Then in 2002, minus 1.6%. In 1998, minus 1.8%. Now, how it is minus 8.1%? See, here is 3055. Okay, if you go back 5 years, 1, 2, 3, 4, 5, the index was 3346, 3346, and compared to that, 3055 is lower. But what has been the annual return? 3346 becoming 3055 gives an annual return of minus 1.8%, because 3055 is lesser than 3346. Okay, that gives an annual return of minus 1.8%. So on 3 occasions, that is in 1980, 1998, 2002, and in 2012, the returns have been negative. What does it show? Out of 37 occasions, only on 3 occasions, the annualized return has been negative, taken over a 5-year period. It means that the longer you stay invested in the share market, the more beneficial it will be to you. If you calculate similarly return over a 10%, 10-year period, instead of 5-year period, if you calculate returns over 10-year period, those have also been calculated. They are in the hidden columns over here. The sheet has been attached to the course material, so you can open the sheet on your laptop and you will be able to see the returns over a 10-year period. On no occasion out of 10 years, 10-year returns on no occasion have been negative. In the sense, it makes sense to remain invested in stock market over very long periods, such as 5 and 10 years at a time. Okay, fine. If we calculate the annualized returns, for example, if you take the index at about 52,773 as on it was 28th June, almost half the year is over. So this compared with the first index of 527.36. This is a period of 36 years. In 36 years, how much has been the growth of Sensex? It has been a compounded annual growth of 13.645. The correct figure is 13.645 because I have shown it only to the extent of 1 digit. It has got restricted to 13.6. The actual number is 13.645. So just imagine 13.645% per annum has been the return over a 36-year period from 1985 to 2021. Similarly, if you calculate the returns from gold from 1985 again to 2021, their annualized return of 8.99% or 9% rounded out. Okay. In other words, if you had invested an amount of rupees 100 only in 1985, if you had invested an amount of rupees 100 in 1985, that amount would have been worth rupees 10,007 in 2021. So 100 times growth, 100 has become 10,000. So 100 times growth has happened. Similarly, in gold, if you had invested 100 rupees in 1985, that would have been worth 2,207 rupees. That is 22 times growth versus 100 times growth. So there is no sense in comparing the Sensex and gold return. There are 350%, 450% more than gold return. Sensex offers returns which are more than 450% of the returns offered by gold. Now see, there are several mutual funds which have outperformed the Sensex. Sensex is what? Sensex is the total market growth as measured by the index called as Sensex. Nifty is similarly measured by an index called as Nifty. It is chosen 50 shares out of top 100. Okay. Now, if you had a situation where 1% growth over Sensex, if you had assumed 13.645 is the index growth per annum. If you had found out the growth which was 1% higher than this, several mutual funds have beaten Sensex. Okay. If the returns were 1% more than Sensex, it would have amounted to the same 100 rupees would have amounted to 13,717 rupees. That means a growth of 137 times. 1% difference in the returns. 13.645 instead of 13.645, we take it 14.645. 100 rupees becomes 10,000 rupees in 13.645 rate, and 100 rupees becomes 13,817 rupees, that is 137 times. And if the growth is 2% above Sensex, that is 13.645 plus 2, that is 15.645. The same 100 rupees would have become 187 rupees, 187 times. Okay, fine. So this has been the growth. Now, this growth is stupendous, but how does it come about? Okay, I'll take you through the total process. Now, see, I have identified the Sensex returns. I have seen what are the top 250 shares or other 600 shares we have seen. Now, I'm attaching these documents to the course material, so you can see this at length, because the course has to be limited to 2 hours duration. That's why I am running against time. I'll be taking you only to the essentials. Okay. And in the next class, we'll cover some more issues. Thank you. Welcome back. We have seen previously that the returns from share market and the other class of investment, that is gold, are just not comparable. The Sensex over a period of time has given the returns of 13.645% compounded annually over a 37-year period from 1985 to 2021, that is 36-year period. And similarly, the gold has given the return of 8.99% over the same period. So 8.99 is to be compared with 13.645. As a result, what happens is, if you had invested 100 rupees both in Sensex and gold at the same time in 1985, it would have become 100 times in case of Sensex and about 22 times in case of gold. So this has been the disparity in the returns. So in other words, in any developing country, the returns from the stock market would generally be far superior compared to most of the classes of investment. Now, coming back to the spreadsheet which I had used, we had defined what are large cap shares, mid cap shares, and small cap shares. Now we'll come to what are large cap mutual funds, mid cap mutual funds, and small cap mutual funds. See, coming here, we have seen that Reliance Industries at the top with 14,000 billion rupees. So these 100 shares which are designated as large cap, if a mutual fund buys predominantly in these large cap shares, then it's a large cap mutual fund. Okay, so the definitions are simple. Fund investing in large cap shares is large cap mutual fund. Fund investing in mid cap mutual shares, mid cap shares is mid cap mutual fund, and fund investing in small cap shares is small cap mutual fund. There are two other categories. Which is multi-cap and flexi cap. Multi-cap category is not there now, but flexi cap category allows you to hold shares across various capitalization. So we are not on that, because see, we want to have a certain pattern of investment, which we'll discuss when we go to my presentation. So I'm only listing large cap, mid cap, and small cap mutual funds. Fine. Now, for example, if I go to this sheet, okay, shares held by mutual funds. Two mutual funds have been listed, which are large cap, namely Axis Blue Chip Fund. Axis Blue Chip Fund is a large cap fund. Then Another large cap fund is Canara Robeco Blue Chip Fund. There is also a large cap fund. So predominantly, if you find there are a lot of commonalities, between these shares and the shares held by Canara Robeco. There are some different shares, some are same. Okay. So now this, what is this? This shows as on a recent date in July 2021, this is the percentage holding of the fund in this share. For example, Canara Robeco Blue Chip Fund is holding HDFC Bank to the extent of 7.85% of their total assets under management. So whatever the total funds collected by the Canara Robeco Blue Chip Fund, 7.85% of that has been invested in HDFC Bank shares. Okay, so this is the meaning. Like if you say there are some 15-20 shares in case of Canara Robeco, similarly there are I think 26 shares in case of Axis Mutual Fund. It is not necessary that all these shares have to be large cap. For a large cap mutual fund, not all these shares have to be large cap. Some could even be, so to the predominant extent they have to be large cap, but to a small extent it can even have shares like small cap and mid cap also, but predominant presence should be in the large cap space. Fine. So this is what it is. Now say, when we come to advantages of mutual fund, I have said there that it is possible to hold fraction of a share. Okay. For example, in Axis Blue Chip Fund, if we go, the top holding of Axis Blue Chip Fund is HDFC Bank, and it is to the extent of 9.16%. That means whatever assets under management or the funds collected by Axis Blue Chip Fund, 9.16% of that has been invested in HDFC Bank shares. Okay. Now, for an investor who is therefore investing in Axis Blue Chip Fund, he will hold all these shares proportionately. In other words, if a person is investing, let's say 10,000 rupees, if by investing 10,000 rupees, it is not possible to hold all these shares, but some of the prices of these shares are more than 3,000, 4,000 also. So it is not possible to invest in all these shares. But by investing in Axis Blue Chip Fund, it is possible to have, for a person, by investing only rupees 10,000, it is possible to have 0.61 of HDFC Bank share. That means little more than half. This is also little more than half of Infosys share. Okay, 14% of Bajaj Finance share. Okay, so this is what it is. So this is the breakup. Okay, now coming back, I'll go to another presentation. I'll go to the actual presentation for this course. Now let me share the screen once again and go to this presentation. Yeah, here we are. So the title of the presentation is Asset Class of Mutual Fund Investment, the Indian Scenario. My name is Madhusudan Soni. Now it is like this. In the next slide, a little bit about myself. I am Madhusudan Soni. After working in the finance sector for 26 years, and after working for another 18 years in the teaching line, now I am a teacher at Udemy. I have created 6 courses in the subject Operations Research, which is a mathematical subject. I have so far got 6,500 students all over the world from some 130 countries and 11,100 registrations. Why there is a difference between students and registrations is that one student may have registered for more than one of my courses. Therefore, 6,500 students have totally registered for 11,100 different courses. Okay, all conducted by me only. With most student data, this data as on 3rd July 2021. Okay, now this course, the present course that we are talking about, I have created this course for Indian investors who want to invest in equity mutual funds. Okay. Now there are several sources of information for mutual fund investors. Some of them I have listed here. For example, there is a valueresearchonline.com. Okay. Now there is no need to copy this anywhere. I'll be giving you a copy of this presentation as a part of the course material. So you can refer to that anytime, as many times as you want. All the information which is contained in this presentation will also be contained in the document which I'll be sending in the course material. So valueresearchonline.com, morningstar.in, moneycontrol.com, and economictimes.indiatimes.com. These are some of the well-known sources of information on mutual funds. I, however, find that one of these, namely valueresearchonline.com, is the most reliable, unbiased, and more importantly, updated most frequently. Almost on a weekly basis, this website is updated. And therefore, what I have said in this course is relied upon is drawing upon most of the information from valueresearchonline.com. Okay, fine. Now, mutual fund investments, it is for whom? Let's go to the various requirements of various people. For those who want to get the benefits of stock market, attracted by the returns of stock market at 13.645 over a 35-year period, if you are attracted to investment in stock market, but you don't have the expertise or time or inclination about shares, you don't know how a share is identified, how a share is bought, okay, and you have no inclination or even expertise in buying the share, then you are a customer for mutual fund investment. Those who have retired but have to keep aside some money to beat inflation. You have seen that consistently in the last 10 years, the average inflation rate in India has been around 6.5%. From about 2010 to about 2020, the inflation rate in India has been around 6.5% per annum. So the only asset class which beats the inflation is equity. And equity measured just by Sensex is giving you returns of 13.645 over a 35-year period. Okay. Those who want to keep aside money for target events. What are the target events in a working person's life? Like children's education or marriage. For that, you are collecting money. And if you plan in advance and invest in mutual funds, these are called as target events. Okay. Those who want financial independence in retired life, very obviously one would not like to depend upon others in retired life. Therefore, those are the investors for mutual fund. I have seen another class, those who are in the middle of their career, 40 to 50 years or 35 to 45 years, and they have no time for taking care of their own investments. And for them also, a passively managed, that is, you are not managing it, you are only investing it. It is somebody else is managing. So that class is also an important class. Those who are in the middle of the career and have no idea of taking care, no time for taking care of their investment, they are also customers for mutual funds. Sensex returns have been tabulated. I have shown you 1980 to 2021. Actually, I have shown you only 1985 to 2021, but the data has been used from 1980 to 2021. Observations. What are the observations based on that? Out of 37 occasions, on 3 times only, Sensex annualized returns have been negative as calculated over a 5-year period. Okay, so today to 5 years hence, if you calculate the return, they have been negative only on 3 occasions in 37 times. Out of 32 occasions, remember, out of 32 occasions where the returns have been calculated over a 10-year period, they have never been negative, not even a single time. So what is the message from this? The message from this is that the longer you invest in share market, the better are the chances of appreciation. Okay. Now, for want of quick data, I have not tabulated Nifty returns. One thing is Nifty returns, the data is not available from 1981 because Nifty came into existence much later. But if you calculate the year-to-year returns from Nifty, they are expected to follow the same trend, Because what it is basically an index that we are talking about. And I have seen, for the purpose of my students, I had calculated once the correlation coefficient between Sensex and Nifty. It is over 98% correlation. That means it is perfectly correlated. Nifty and Sensex are perfectly correlated, in the sense whenever Nifty has gone up, Sensex has gone up. Whenever Sensex has fallen, Nifty has also fallen. Fine. So this is the situation. Therefore, Sensex data is as reliable as Nifty, or Nifty data is also as reliable as Sensex. There are some advantages of mutual fund. You cannot invest in a fraction of a share in the share market. I have shown you the presentation just now. Mutual fund make it possible to own a fraction of a share in several companies by investing as low as 1,000 rupees per month. For example, I have seen that by investing 10,000 rupees in the fund called as Axis Blue Chip Fund, you will be owning 0.6 shares of HDFC Bank. Okay, fine. You don't have to bother about placing orders for several fractional shares. See, Axis Blue Chip Fund is investing in several shares. If you were to buy all the shares, even those fractional shares, supposing they were available, you will have to place so many orders and obtain so many shares. Okay, so that is not required to be done. You don't have to know the fundamentals of the shares that you are investing in. You don't have to know what is HDFC Bank about or what is Infosys about, because the fund is buying it. You are anyway getting it by your investment. So you don't have to know about the fundamentals of shares. How are they doing? What are their financial performances? What is their EPS? What is the PE ratio? All the jargon you don't have to know. Okay. Then you don't have to monitor the prices of shares. For example, if you really invest in all those shares which are held by Axis Blue Chip Fund, you'll have to monitor them in terms of price. Every day there are ups and downs in the market. So you'll have to keep monitoring and get tensed up. If one share goes up, the other share goes down and all that. You don't have to do that. Once you have invested in Axis Blue Chip Fund, it remains invested in Axis Blue Chip Fund. Okay. You can withdraw some dividend. This is an advantage, I would say. You can withdraw some dividend by opting for the dividend option. If you opt for the dividend option, whenever the mutual fund declares a dividend, that dividend you will be entitled to. Okay, but it is a better idea to remain invested if you don't require the money in hand. Actually, if you don't require the money, it is better to remain invested, because even the dividend would grow at the compounded growth rate. Correct. Now, just as there are advantages, there are disadvantages of mutual fund also. Like you have no control over the shares being bought. See, just as there is an advantage, every advantage, if you look at it from the other point of view, it's a disadvantage also. For example, you have no control over the shares being bought. You want to not buy HDFC Bank. You can't say by buying Axis Blue Chip Fund, you can't say that I don't want HDFC Bank. HDFC Bank will be bought in the same proportion. Okay. So no control over the shares being bought. You may miss out on the extraordinary growth opportunities offered by a single share. For example, I'll tell you, Bajaj Finance is a share. It has witnessed meteoric rise. For example, only about 6 months back, the share was quoting at about 4,000. Now it is 6,000. So 50% annualized, 50% growth rate in 6 months is what it has happened. So you will not be entitled to such growth, because you will be buying a basket of shares which the fund is buying. You are not entitled to dividends declared by Indian company, by the individual companies. For example, if Axis Blue Chip Fund or Canara Robeco Blue Chip Fund, they are investing in several shares, and out of those shares, some declare dividend and they are paid to the fund. You are not entitled to the dividend. What happens is, when the dividend comes, it gets added to the net asset value of the fund. Okay. In the share market, you have a choice. Now, in the share market, say if you go to Bombay Stock Exchange or National Stock Exchange, you have a choice of buying either an IPO, a new public offer, okay, or initial public offer as it is called. You can buy a share from the mid cap space or the small cap space or the large cap space. But in mutual fund, you have to go by the theme of the fund. If the theme of the fund is such that it is large cap, 85% of the investment will be in large cap, or 85% of the investment will be in mid cap. Okay, so you have no choice about you have to go by the theme of the fund. You have no choice about individual shares. You have no control over what to buy or sell. Having bought the fund, you are a passive spectator to the fund's performance. Once you buy the mutual fund, you know, you are confident enough that over a 5-year or 10-year period, it will show good growth. But you don't have to bother about the performance. You can measure the performance maybe once in 6 months. Okay. And if you are a passive spectator, in the sense, you don't have to know what is the individual shares prices. Okay. You should know only what is the asset value of the units of the fund which you have bought. Okay. Now you have to bear high cost of fund management, which ranges, this is a very negative point, 2.1 to 3% of the cost, yearly cost, is required to be incurred only for management of the fund. See, there are salaries of the fund people, there are commissions payable to the intermediaries. All these total to 2.1 to 3%. In other words, the returns of the fund, whatever are return generated, they get reduced by 2 to 3% per annum. Okay, and that's a huge setback. But what happens is you can go for a direct plan instead of a regular plan, and you can try to reduce the fund management cost. Okay, we'll come to that in the next slide. Like, see here, how to mitigate the risk of share market by investing in mutual funds. Okay. Now, what is the best way? The best way is to make a commitment to yourself that I will invest an X amount per month in this mutual fund. For example, Canara Robeco Blue Chip Fund, if I choose to invest in, I'll invest 5,000 rupees per month in this fund. It's a commitment which you are making to yourself. Then you start an SIP. What is an SIP? SIP is a systematic investment plan which commits a certain amount, okay, to be invested regularly in that particular mutual fund. Okay. So systematic investment plan takes care of most of the risk associated with mutual funds. Like, what are these? And systematic investment plan is a commitment to buy mutual funds in a monthly manner of fixed amounts, like let's say 5,000. Okay. By remaining invested over long periods such as 5 to 10 years, we have just seen that 5 to 10 years, if you are invested, the chances of risk or chances of the capital being eaten are very low. Okay, the returns have hardly been negative over a 5-year or 10-year period. For 10-year period, they have never been negative. Over a 5-year period, they have been negative on 3 occasions out of 37 occasions. By allowing the funds, the money to grow in a compounded manner, by opting for growth option and not withdrawing dividend. If you take dividend out, that much money is reduced from the fund. Therefore, if you want to grow at a faster rate, and if you don't require money by way of dividend, it is better idea to remain invested in the fund, so that that dividend income which you would have got also grows at the same rate, same compounded rate. Okay. By opting direct plans instead of regular plans, okay, you can opt for direct plans instead of regular plans. Thereby, you can bring down the fund management cost, which was 2 to 3%. Okay, this way you can bring down the fund management cost by 1% to 1.5%. So it is possible to bring down the total fund management cost to less than 1%. Okay, so this is possible if you are tech savvy. You can invest in direct schemes, and direct schemes, if you see, it is like this. If the returns from a regular plan is 13.8%, the return from direct plan is 14.8%. There's a 1% difference almost, or 0.75% difference almost in every scheme over every tenure. Okay, so this is one good way of bringing down the fund management cost by 1.1 to 1.5%. Now, how to choose mutual funds for investment? Well, this is an important issue, and this will be your most important input from this course that you will be receiving. First of all, you have to decide on the amount that you want to invest. Let's say 10,000 or 20,000 rupees per month. Then break it up in this ratio, 50, 40, 10. 50%, 40%, 10%. So if you are investing 10,000, it is 5,000, 4,000, 1,000. Okay, 5,000, 4,000, 1,000, or it can even be 50, 35, 15. 50, 35, 15. So it can be 5,000, 3,500, 1,500. Okay, break it up into this proportion and invest in large cap, mid cap, and small cap shares. Okay, the idea is 50% of it should go in large cap. It offers stability to the portfolio. 40% can be in mid cap and 10% can be in small cap. Now, this is a suggested pattern for a relatively conservative investor. Now, if you are not conservative and if you are not risk averse, you can even reverse the pattern. It can be 10, 40, 50. In other words, your 50% investment can be in small cap shares. But remember, as you go down the ladder in the market capitalization, the risk increases. So large cap, there is least risk. Small cap, there is highest risk. Okay. Go by the suggested plan of investment as brought out herein, which I'll be showing you. Monitor your investment once in a period of 6 months. There is no need of monitoring. Just go on blindly investing in a monthly manner. Invest in a 5-star or 4-star funds only, since the stars are assigned after a lot of research. See, in a category, for example, large cap, there may be, let's say, if there are 100 or 200 funds, see, first 10% funds are only allotted 5 stars. Next 22.5% funds are allotted 4-star. So what is the proportion of 4-star and 5-star percent funds? 32.5% funds in any category, whether it is large cap or mid cap or small cap. 32.5% category forms in the 5-star and 4-star category. Okay, rest of them all are 3%, 3-star, 2-star, 1-star, and no star or unrated. Okay, stick to 5 and 4-star, as I have said. Okay, how to go about this, I'll show you. Okay, now if you go here, I'll come back to this presentation little later. Once again, we'll start with Axis Blue Chip Fund. Now see, I'll just briefly mention that in the large cap funds, these 6 funds are in the 5-star category, namely Axis Blue Chip Fund, Canara Robeco Blue Chip Fund, HDFC Index Sensex, ICICI Prudential Sensex, and Mirae Asset Large Cap, and Tata Index Sensex. These are funds which are in a 5-star category. Okay. Now, welcome back. I'll take you now to the various websites which I have referred in the document. Now let's go to one important website called as, let me check. Yes. Let's look at this website. The name of the website is valueresearchonline.com. The name is contained in the course material which is attached to the course. So valueresearchonline.com. This is the name of the website. If I click on this, this page will open. Okay. This is the general page which will open after clicking on valueresearchonline.com. There at the top, you will find a word funds. Okay. So if I click on funds here, okay, apparently nothing has happened on the page, but if you go at the end of this page, okay, here you will find various categories of equity funds. For example, equity large cap. Click on one of the categories. Let's say equity large cap. Okay, I'm clicking on equity large cap. So what happens after this is only equity large cap funds will be displayed over here. Okay, equity large cap funds will be displayed over here. Now in these equity large cap, there is all categories: unrated, 1-star, 2-star, 3-star, etc. So to remove those, see here there is rating: 5-star, 4-star, 3-star, 2-star, 1-star, and unrated. You remove all categories except 5-star and 4-star. Okay, so keep 5-star and 4-star. Keep regular plans, not direct plans. Okay, because regular plans are more prevalent, therefore I'm going to regular plans. Keep equity large cap over here. Okay, and then click on update fund list. Okay, now see what has happened on the page. all funds rated only 5-star and 4-star are reflected here. If you arrange these funds in the increasing order or decreasing order of stars, like say if I click on rating 2 times, if I click on once, it is 4-star at the top. If I click second time, 5-star is at the top. So out of large cap equity funds, how many of them are in the 5-star category? 1, 2, 3, 4, 5, 6. Only 6 funds are in the 5-star category. Rest of them all are in the 4-star, because we have chosen only 4-star and 5-star. Okay. See, this is the way to generate the list. Now see, for example, over here, which are the 5-star rated funds? Axis Blue Chip, Canara Robeco, HDFC Index Sensex, ICICI Prudential Sensex, Mirae Asset Large Cap, and Tata Index Sensex. Okay, so these are 6 funds which are rated as 5-star. Rest of them are 4-star. We are not even looking at 3-star, 2-star, 1-star, and unrated. Okay. Like see, once this page opens, we have kept regular plans, not direct plan. Now you can explore this page in a very substantial way. For example, I'll click on returns. Okay, we are interested in returns per se. So returns, I'll click on. Okay, after that, we'll click on long-term returns, not short-term. We are not interested in short-term. We are not there for getting in tomorrow, getting in today and getting out next week. No, we are there for long-term. Therefore, I'm clicking on long-term. And in long-term, you will find different categories. 3-year returns, 3-year rank. 5-year returns, 5-year rank. 10-year returns, 10-year rank. Okay, so 5-star is a good measure. So I'll click on 5-star. So what happens if I click once on 5-star, the lowest returns will come at the top. But if I click twice on 5-star, the highest returns will come at the top. So these are your funds. These are your funds. See, the same category, the same funds which had 5-star are appearing over here. Canara Robeco, Axis Blue Chip, Mirae Asset, HDFC Sensex. Motilal Oswal was not there in the 5-star category, but it has propped up here in terms of returns. Okay, so these are 5-star and 4-star rated funds organized in the decreasing order of 5-star returns. And what is 5-star return is 16.87%. 5-star return of 16.87% is 16.87% per annum for 5 years. You remember our return for 35-year period was 13.645%. This is 16.87%. So which is more than 3% points above 13.64 point. So imagine the growth taking place at this rate. Okay, so these are annual long-term returns. Now, if you had invested in SIP, okay, systematic investment plan, what would be the returns? You click on this, you will get the returns. Okay, 5-year return SIP, 3-year return SIP. Then portfolio. If you click on portfolio, you will get some other details. So explore this page carefully, and particularly I'll be showing you about the risk statistics. Okay, for example, if I click on risk statistics, various details are shown here. See, these are the risk statistics ratios. Riskometer will be very high for all the categories of all the 5-star and 4-star categories. So there is nothing to choose from. They are all high risk funds. Obviously, equity investment is a high risk investment, but you can reduce the impact of high risk by investing over a longer tenure. Riskometer, therefore, is to be ignored. Standard deviation. Standard deviation, lower the better. Okay, this is the highest standard deviation, 22.23. Lower the better. Lower is in which fund? Axis Blue Chip Fund Regular is lowest standard deviation, and which is the highest? Highest is SBI Nifty Index Fund, 22.23. See, what happens is an index fund is supposed to replicate the index. For example, a Nifty index fund will invest in the same Nifty shares in the same proportion as Nifty. Okay, therefore, the beta of this fund will be close to 1. What is beta? Beta is relative volatility. Beta of Nifty is supposed to be 1. Or if it is Sensex, beta of Sensex is supposed to be 1. Out of Sensex funds, if some fund, some share is having beta of higher than 1, some shares will be having beta of lower than 1. Okay, so it is like this. Any Nifty index fund, particularly if it is index fund, the beta will be close to 1. Beta is 1 here, 1 here, 1 here, 1 here. See, so these are all index funds. This is Nifty index, this is Nifty index, Sensex index, Nifty index, Sensex index. All these are having beta equal to 1. Standard deviation, lower the better. Therefore, you click on once or twice, you will get lowest at the top. Okay. What is standard deviation? Standard deviation is a measure of variability of the returns. How much are the returns variable on plus and minus side? Okay. So it's a variability measure. Sharpe ratio, Sortino ratio. These are some of the ratios associated with the risk parameters. Sharpe ratio is what? Sharpe ratio is returns offered by the fund in excess of market returns, okay, divided by the standard deviation of the fund. So what is the criteria? Higher the better. Okay, higher the better. If I say now this is lower, now this is say Canara Robeco Blue Chip Equity Fund has come at the top. Then comes Axis Blue Chip Fund. See, Axis Blue Chip Fund is always featuring at the top somewhere. Okay, so this is 0.74, this is 0.66, this is 0.74. Sortino ratio is also something similar to Sharpe ratio, but there the negative variations are only taken into account. If a variation is higher than the benchmark, then it is ignored. If it is lower than the benchmark, then it is considered. Okay, so Sortino ratio is more liberal compared to a Sharpe ratio and gives a more accurate picture. Again, higher the better. Sharpe ratio higher the better. Sortino ratio higher the better. Beta lower the better. Volatility of the fund will be lesser than the volatility of the market. For example, if I organize it in the decreasing order of beta, what has come at the top? Axis Blue Chip Fund has come at the top. In other words, this beta is 80% of the Sensex beta. In other words, Sensex beta, if it is 1, this is 0.8. 80% less volatile. It is 20% less volatile compared to Sensex. Okay, so this is beta is 80%, beta of Sensex is 100%. Alpha, higher the better. Okay, for example, the highest alpha has been generated by a fund called as Canara Robeco Blue Chip Fund. Okay, 3.74 over and above the market. Okay, fine. So, and R squared, these are some of the fund categories, risk categories associated with the fund. NAV details, if you are interested, what is the present NAV, what is the 52-week highest and lowest NAV. Here is important criteria called as fees and other details. Okay, here expense ratio is mentioned. Out of the return generated by the fund, first 1.77% return is going away in the form of expense ratio. Okay, in case of Axis Blue Chip Fund, the returns are stated after removing this 1.77%. In case of BNP Paribas, 2.25% has to be removed before stating the return. Like see here, if you see, if I keep this page and if I click on direct plans, okay, and if I remove the regular plans, you will find some of the funds having expense ratio as low as 0.10. There are not many funds with this ratio. ICICI Prudential Sensex Index Fund. Okay, Nippon India only index funds will be having expense ratio of less than 0.5. So 0.10. In other words, for every 100 rupees, okay, 10 paise is the expenses. Okay, just imagine how efficiently the funds are managed, because these are what? These are managed in a passive way, but these are managing by investing in the same proportion as index. The fund manager doesn't have to think of anything. Whatever is the composition of index, he has to invest in the same proportion in the index fund. So the work involved is less, the expenses are less, the research involved is less. Okay, so these are the expense ratio. Here there is, you will find exit load. Exit load. What is exit load? Exit load is applicable in case you quit the fund in less than 1 year. For example, in case of regular plans, okay, if I go to fee and other details, and if I go to expense ratio, highest expense ratio was in case of Sundaram Select Focus Fund, and the lowest ratio was 0.30 in case of UTI Nifty Index or ICICI Nifty Index, ICICI Sensex Index. Okay, so these are expenses in case of regular plan, and these are expenses in case of direct plan. You can get the expenses of direct plan. See, for example, 2.26 is the expense in the regular category. Now, if I click on direct, and if I click over here, Sundaram, 2.26 is the, sorry, I have to remove this, 1.27. So 2.26 has become 1.26, or almost 0.99% less expenses in the direct plan compared to regular plan. So as I mentioned I mentioned previously, the expenses can be brought down to the extent of 1 to 1.5% by choosing direct plans for investment instead of regular plans for investment. Okay, so this is what this is. And see, in the returns category also, you can go to short term, long term. Short term will give you a very short term picture, what has happened in 1 week or 1 month. That is not a correct parameter for judging the performance of a mutual fund. Okay, for example, if you are a very long term investor, I should click on this. There are no funds. In other words, there are no funds in the direct plan over 10 years. Now see, if I click on this in the regular plans, long term, Mire Asset Large Cap Fund has given the highest of the returns at 15.52%. Remember, our benchmark returns were 13.645. This is much higher than that. 15.52 is almost 2% higher than that. So you can imagine the growth. Okay, so Mire Asset Large Cap, if you had invested 10 years ago, you would have got a compounded return of 15.52% even in the regular plans. Okay, now it has been possible to invest in direct plans. 10 years ago, it was not possible to invest in direct plans. Okay, so direct plans returns will be higher than the regular plan returns in general. So this is how to explore the page, and this is how to take advantage. Like, see, for example, here, if I come, I want to point out another category. Now, if I remove the equity large cap, and let's go to equity ELSS. Okay, what is ELSS? ELSS funds are those which offer tax benefit as also the share market linked returns. Now, if I click on update fund list, okay, only ELSS funds will be propped up in this list. Like, see here, update fund list. What has happened here? Only ELSS funds have been shown. Okay, go to snapshot. 5-star and 4-star we have already chosen. See, these 3 funds are in 5-star category, but the number of funds in ELSS category is less. Therefore, the number of funds having 5-star is also less. So only 3 funds are in 5-star category: Canara Robeco Equity Tax Saver, Mire Asset Tax Saver, and Quant Tax Saver. So these are 3 funds in the category for regular returns. If you go for direct returns, the picture may be slightly different. Canara Robeco, Mire Asset, Quant. So same funds are there in the top 3, whether you go for regular category or direct category. Now here, if you see, these 5-star rated funds at the top have come, Canara Robeco. Let's see the advantages of investing in this. If you go to returns and if you press on long term, okay, Canara Robeco is over here. What is the return per annum? The return per annum over a 5-year period is 18.04%. If you organize them in the decreasing order of returns, the top ELSS fund has given 5-year returns on the basis of 23.42%. Imagine the growth. We know the growth at 13.645. What is the growth at 23.42%? It's easy to calculate. Calculate that and see, this is only from regular plans. Direct plans will be even higher. Okay, so this is what the page is about. Now in this list over here, you will find various categories. If you want to have all equity funds, you can keep all equity funds. Okay, then you can retain only 5-star, 4-star out of all equity funds, and then order them in the decreasing order of 5-star and 4-star. Okay, so various things are possible. Now I am on the subject of thematic allocation. So 50, 40, 10, when I say, I'm saying 50% in large cap, 40% in mid cap, and 10% in small cap. So if you follow that pattern, if you see here, you will find mid cap as a category. Equity ELSS is a category which I am removing. Now, for if you are not looking at tax advantage, then equity large cap fund is here. Okay. Then equity mid cap funds is here, and equity small cap funds is here. Go on exploring the page, but I have already created this data for you, and it will be shown in the form of presentation. I'll be showing the presentation to you also. Okay, I have just shown you how to go about this page. Now, similar facilities are possible using Morningstar or Money Control, but I'm not very happy about the way the data is updated there. So I would prefer to go to valueresearchonline.com, but I have been using this website for several years now, and my experience has been very good. It is totally unbiased, does very good job of it. Okay, so now coming back, I'll close this lecture, and then we'll go to the next topic in the next. Welcome back. We'll start where we left last time. Now it was on the, I think it was on the mutual funds of large cap category. Yes, this is where we were. The top 3 funds, top 6 funds are listed here in the large cap category. Now coming to the next slide, that is mid cap funds. What are the top mid cap funds? If you go to the same website, all this data has been culled from valueresearchonline.com. In this website, you can just click on the category of funds. For example, large cap, mid cap, small cap, flexi cap, ELSS, thematic funds, etc. And you can get details about all the funds in that category. So that exercise has already been done by me as recent a date as possible, like something like 3rd July. This data is valid as of 3rd July. There won't be much of a change with the passage of time. Okay. At the most, what may happen is something adverse happens. This 5-star may become 4-star, or one of these 4-star funds may become 5-star. Okay. Now, in the mid-cap funds, if you see, the top 2 listed funds have been mid-cap Axis mid-cap regular and PGIM India mid-cap opportunities. These funds are the fund, and I have listed only the regular category funds, not the direct funds. Direct funds will have a little higher return than the regular funds. Now, these 2 funds are the topmost lifted. So what is our strategy? Our strategy is to invest in a recommended proportion in large cap, mid cap, and small cap. In large cap, I have shown you which are the funds. In mid cap, these are the 2 funds where you can invest. Okay. In the small cap, however, there is not much of a choice. There are only 1 fund has been listed in 5-star category, and that is Axis small cap. See, surprisingly, Axis blue chip fund is one of the top performance in large cap funds. Axis mid cap fund is one of the top performance in mid cap funds, and Axis small cap funds is one of the top performance in small cap fund. This is the situation as of today. So Axis small cap fund is the only fund which has a 5-star rating. Only one fund is rated as 5-star. The reason being the number of funds in the small cap category are much smaller. Therefore, one fund has been rated as 5-star. So, and see, this is one of the funds which was established recently compared to the other funds. This was established in November 2013, okay, about 8 years ago. Compared to the other funds like Kotak Small Cap has been launched in February 2005, so 8 years before this, okay. And this is September 2010. This is September 2009. But among them, the most successful has been Axis Small Cap Funds. Okay, there are other funds in this category, but they are not rated as 5-star or 4-star. So I have listed only 5-star and 4-star. I have shown you the method to list them into 5-star and 4-star. So this is the broad category of large cap, mid cap, and small cap. ELSS funds is something which I have explained to you. ELSS funds is what? ELSS funds is the funds which give you the returns related to stock market. Okay, and a tax saving. A tax saving is also possible. Under 8IC, you get various benefits of income tax up to the sum of rupees 1.5 lakh. So this is one of the best investments in that category. The reason being, there is a lock-in period of only 3 years for these funds. After 3 years, if you quit, you pay the long-term and short-term tax, etc. But you can quit after 3 years. The requirement for 8IC is that PPF. See, PPF is locked for 15 years. National Saving Certificate, the money is locked for 6 to 7 years. So this is one category of funds which gives you high return, and you can quit after 3 years if you wish. And another thing which you can do is you can quit after 3 years and utilize the same amount to invest in another fund, and you can get another tax benefit in that year. Okay, so this is a very advantageous fund, I would say, ELSS fund. And ELSS fund, 3 funds have been rated as 5-star. So these are your funds. Okay. Out of this, I would prefer the first two, Canara Robeco Equity Tax Saver and Mirae Asset Tax Saver. The reason being their asset size has been quite large. 2,227 crore and 7,940 crores is the asset size as on a recent date. The quant tax has been outperformer, but its asset base is 204 crore rupees. So the flexibility which is available with these funds may not be available with this fund. So I would recommend these two to you and not this, though it is rated as 5-star. But you have your own choice. Okay. Now ELSS funds we have seen. Small cap, large cap, mid cap we have seen. ELSS funds we have seen. Coming to the next category of Flexi Cap funds. What are Flexi Cap funds? Flexi Cap funds is a very funny thing in the sense, they have no restrictions about the market capitalization. In terms of large cap, mid cap, or small cap, they have no restriction. They can go to any capitalization. They can invest theoretically all the money in small cap or mid cap or large cap at any given point of time. Okay, so that is the advantage. And therefore, if you want to choose, let's say, only one fund, you don't want to invest in large cap, mid cap, small cap, etc. You want to invest in only one fund. These are these 5 funds for you. Okay, these are 5 funds recommended for you. They are all Flexi Cap, so you will get some exposure in large cap, some exposure in mid cap, some exposure in small cap. Not of your choice, not in the 50-40-10 ratio. Okay, but you will get presence in all these capitalization types, and you will get good returns, 5-star returns. Canara Robeco, IIFL Focused Equity Fund, Parag Parikh Flexi Cap Fund. This fund also invests in the US market to some extent. PGIM India Flexi Cap and UTI Flexi Cap. These 5 funds are recommended to you because they are all 5-star funds. Their asset base is also quite substantial, ranging from about 1,000 crore rupees in case of PGIM to about 18,000 crore rupees in case of UTI Flexi Cap. And yet they are in 5-star, so their performance is very good. Fine. Now, coming back to the method of investing, now see, there are other funds also, like thematic funds. What are thematic funds? They go by the theme of the fund. For example, banking. Banking is a theme. So predominantly, the entire investment of the fund would be in banking sector. Okay, banking fund, infrastructure fund. Infrastructure fund will typically invest in infrastructure projects. IT funds will typically invest in IT companies, okay, pharma funds. But this is what? This is taking a risk on that particular sector, which I don't recommend. I would recommend to you to take a risk on the entire share market. Okay. So if you go by pharmaceutical, see, pharmaceutical these days have good days, pharmaceutical. But there was a time 2 years back when the pharma shares were lagging all. So it is not advisable to, if you are investing in a single or two mutual fund, it is not advisable to invest in thematic funds. Okay. So this is the investment in Flexi Cap fund. Now coming back to our presentation, we'll continue. If you are a first time investor in mutual fund, okay, for example, you have no idea what was mutual fund is about. So if you want to invest in mutual fund for the first time, you need what? You need only these things to open an account. What are these things? You require a PAN card in your name. Okay. You require an Aadhaar card. You require a bank account in your name. Okay. And be KYC compliant. What is KYC? KYC stands for Know Your Customer. The banks have a certain KYC form. Every intermediary has a KYC form. Once you are KYC compliant, you are KYC compliant across all the products. You are KYC compliant in banking, that will make it necessary for you to be KYC compliant in mutual fund. Automatically, you will become KYC compliant in mutual fund. Okay. So these are the things which you require, and you require to fill in a form initially. Okay. You talk to your advisor. Okay. You talk to your advisor. He will give you the initial documents required. If you are first time investor, once you have done an investment in one of the mutual fund, then the remaining things are very simple. Okay. Now, what if you are not KYC compliant? For want of time and to keep this lecture at less than 2 hours, I do not know how much it will be. I'm going on talking. It may become 2 hours or it may become 1.5 hours also. I have prepared a document and attached it as course material. For what? For all the FAQs that you may have, frequently asked questions that you may have on mutual fund. I have prepared a document and it is attached in the course material. See, to keep the duration under 2 hours, I have restricted myself to telling you only the essential things. Okay. After viewing the video, you can go to the course material and get answers to most of your questions. Okay. Now, what is the procedure? Go to the lecture number 1, 2, 3, 4, like that it is organized. So go to the lecture, click on resources. Okay. Next to the lecture, there will be something like resources. Okay. Click the resources to get the document. Now, what is attached as the resources? One thing is this presentation, which I'm showing you right now. This presentation is attached as resources, and the Excel sheet giving the names of first 663 shares and all that. That is also attached as course material. The name of the document is FAQs about Indian mutual funds. Okay. Please study this and another document. See, this presentation is enclosed, the Excel sheet is enclosed, and a separate document called as FAQs about Indian mutual funds is also enclosed to give you answers to all possible questions which you may have. Okay, please study the document carefully before investing. And the usual disclaimer, mutual funds are subject to a lot of risk. So please invest carefully, read the scheme document carefully. Every scheme document, see, the valueresearchonline.com is such a versatile website. Along with the name of the website, there is a column on the left hand side. There's a column, small column called as PDF. If you click on PDF, you will get to know the scheme document. So what is the scheme objective, how it will be achieved, what is the market capitalization wise things which they are mandated to do, and so on. Okay. Fine. Now, SIP, SWP, and STP. What are these things? I'll briefly mention. They have been covered in the FAQs to the FAQs document also. SIP has been explained in the course. Okay. I'll talk briefly about SWP. SWP stands for Systematic Withdrawal Plan. For example, you receive a chunk of money. Okay, let's say 25 lakhs or 50 lakhs or something like that. And you want to earn regularly by investing this fund in mutual fund. You want to earn regularly some kind of a annuity or some kind of an income. Okay, so it is safe to expect an income of at least 6% to 8% per annum by investing in any one of these shares. Okay, in that case, I would recommend Flexi Cap funds to you, because Flexi Cap offers the flexibility of market capitalization. It offers the flexibility to the fund manager to move across the capitalization. So Flexi Cap fund, if you get a chunk of money, you put it in a Flexi Cap fund and then start an SWP or a systematic withdrawal plan. Every month you can withdraw some amount from the fund, and the fund amount will more or less remain same so long as your withdrawals are restricted to 6 to 8% per annum of the corpus. Okay, if the corpus of the fund is, let's say, X, 8% of that is maximum that I would recommend you to withdraw. I would prefer 6 to 8%. Okay, so this is SWP. STP is another mode of investing. It is similar to SIP. SIP is what? Every month you make a commitment to transfer funds from your bank to the mutual fund. Okay, STP works in a similar way, but instead of transferring funds from your bank to the equity fund, from your bank account to the equity fund, it transfers money from a debt fund to an equity fund. So initially you invest in a debt fund, and every month some amount of that, some fixed amount of this will be transferred in the equity mutual fund of your choice. If you are investing in only one mutual fund, I have said you can invest in Flexi Cap fund. Okay, if you are investing across 2-3 funds, then go by the definition of 40%, 50%, 40%, 10%, or 50%, 35%, 15%. Okay, and please refer to the FAQs on Indian mutual funds to understand how to create a steady income flow through SWP. It has been explained in more detail. Okay, and also understand how to systematically invest in mutual funds using the STP route. Initially you invest in a initially you invest in a debt fund, and from the debt fund every month a certain amount is transferred to the equity fund. So this is what the schemes are about: SIP, SWP, STP. SIP, systematic investment plan, which has been talked about in the past. Systematic withdrawal plan is something which I'm talking for the first time, and systematic transfer plan is also something which I'm talking about for the first time. Okay, so with that, we come to the end of the course. A big thank you to all of you for attending my course. For viewing my short course on Udemy, I am really grateful. If you like the course, please recommend it to your friends and relatives. Okay. See, in India, the penetration of stock market or investment through mutual fund is hardly 4 to 5%. In a huge population of over 1 billion, only 4 to 5% people have benefited from the stock market or mutual fund investment. So let's spread the culture of stock investing, since India has lowest penetration of stocks or mutual funds. Okay, if you have any query, you can write to me at this email address. Okay, and with that, I say a goodbye and thank you all of you. Thank you.